Hey everyone, welcome back. We have the Federal Reserve's decision coming in any second. The Federal Reserve taper. The taper is, of course, the reduction of bond buying from $40 billion per month in mortgage-backed securities and an additional $80 billion a month in treasury bonds. It is a lot of money printing, and at some point here, it will be coming to an end. However, right now, we do expect that the taper will not actually happen. Today, we do expect that the November 4th meeting is now the most likely to experience a taper. And the reason for this is specifically because we expect that because of the jobs report that came in at a miss at the beginning of the month and the inflation readings that held a little bit stable, somewhat stable, we should see some kind of pause and the excitement over having this taper happen as soon as previously thought, which it was supposed to be. There was a pretty good chance it was going to be this meeting, but now it's not. So let's go ahead and get started here. We should be out in about 10 seconds. Sometimes it takes them a little bit longer. It's not out just yet. All right, let's see here. FederalReserve.gov is not even loading right now. Come on. All right, well, no problem. We always have a backup. I might pull this here, and I'll pull the statement up in just a second here. Hold on.
Way to break the linkage between rates and taper would be to move
see what we got
now, but we'll see if that's what they do.
There it is. Do we have it?
Rates were unchanged in the statement here.
Got it.
But
I can't get it.
Said that if economic progress continues, reducing asset purchases may soon be warranted. I'll give you the exact language on that in just a second.
Not yet. No taper yet.
Sectors affected by the pandemic, the Federal Reserve said, have improved in recent months, but the rise of COVID cases have slowed the recovery. And whoever, I think it was David Kelly, said it was right. They did lower the forecast for 2021.
Man.
Back to that in a second. Decision was unanimous. Now, the median forecast now calls for a rate hike in 2022. 9 rate hikes were called for in 2022, 3 of which actually call for 2 rate hikes. The funds rate seen hitting 1.8% in 2024. So quite a bit of work to do. Unemployment rate is forecast, the median is slightly higher, 4.8% instead of 4.5, and a few other things. Somebody was talking about inflation there. They did pull up the inflation forecast, or at least the median forecast of all 18 members, to 4.2 from 3.4. It remains above 2%, interestingly, through 2024. This is our first look at 2024. And GDP was indeed pulled down. I'll give you that number there, 5.9% from such a 1.1% off of the GDP forecast for this year. And next year, actually, they put a little bit back, about a half a point, 3.8%. So they're still seeing above trend growth through 2020.
Okay, we're going to break through this in just a moment. Take a look at this. It looks like crypto is moving higher on that, slightly higher here. ADA jumped up to about 2.2. You've got the S&P 500 mostly moving up here on this news. So that's exciting to see as well. So this was just pretty much expected here that the Federal Reserve would come in with better news than expected. The market's not like super up and down or like super excited about this. It's almost kind of like the market expected this here. We finally got the documents loaded as well. So I'm going to jump this on over. Summary of economic projections. I'm downloading this right now. We're going to pull this up in just a moment. We'll look at it together. Let's listen in here for a moment first.
I would say, Liz, from a few moments ago, but as we know, the first move is often the wrong one, or maybe it's right 24 hours later, and things often change like 28 times in between. With that said, Liz, I totally take your point about how they want to describe the taper. Is the taper, which sounds like could happen in 6 weeks, is that a tightening or not? Well, the whole point is everything is getting tighter. So they're talking about the taper. They're moving the median first rate hike into 2022. That's all pretty consistent with.
And remember, not tapering means more money printing, right? So it kind of makes sense that crypto's moving on this.
The pandemic framework is going away. They're getting us back to something more normal.
Yeah, the evolution is happening, but it's happening very, very slowly. And I think Steve said this earlier today on a different program, that even if they taper at the speed that we're expecting, they're still buying a lot of bonds through the first half of 2022. So it's not as if suddenly the liquidity is going to leave the system or leave the picture. There's still a lot of liquidity that they're putting in.
Nothing out of the ordinary.
As for the market action, I think before we got the announcement, it was interesting to see that the 10-year yield had fallen and equities were up strongly. So at broad brush, you could assume that the market was expecting a dovish statement. But if you pulled back the cover a little bit and looked at what sectors were actually driving, it was cyclicals, right? It was materials, it was energy, it was financials, industrials. So what that would suggest.
Okay, I finally got it. My goodness, I'm sorry. That took a little bit longer here. So we already know their statement, no taper and rates unchanged. We expected that. But this is really what we wanted to look at is the dot plot here, finally. Darn thing. Like their Federal Reserve website was just like the biggest pinwheel. This is not great. But anyway, here we go. Okay, so this is what we want to look at. This is the summary of economic projections for today, which is September 22nd. 2021. Okay, so what we have here is the June projection is this number right here in green. And what you're looking for here are changes to understand where's the Fed's mindset. And so what you can actually see is this modification for the 2021 GDP down to 5.9%. You have companies like Morgan Stanley that are a little bit more bearish than the Federal Reserve here. It looks like you had estimates at 5.8 was the low for estimates here from folks at the Fed. So the Fed a little bit more bullish on the state of the economy here. Looks like inflation, the prior projection for inflation was a 3.4% 2021 projection. That has been moved up to 4.2. But take a look at this. You really see the Fed consolidate their inflation expectations to that 2.2 range by next year. So we're really expecting to see inflation inflect down. Just a matter now of determining, okay, what day are we going to see that kind of inflection to the downside? Let's see here. Also, you know, it'd be kind of funny for doing right now, and I'm gonna do it because why not? Is I'm going to, oh, that's actually not bad. Hold on a sec. I'll tell you exactly what I'm gonna do. All right, you ready for this? Hold on. Give me 1 second here. Okay. I don't know if was a limit going to go through right now. Hold on a sec. Let's see here. Did it go? Okay. Give me a second here. I don't know why Weeble's so slow right now. It's killing me. So there we go. Okay. Cool. There we go. That went through. Okay, so crypto moving obviously on these expectations that the Fed is also now realizing that Fed's probably going to stay up longer. As usual, when I do a short-term trade or a YOLO, I send an alert out in the Stocks and Psychology of Money group. I'll talk about this in a second here. I just want to make sure get this all done. But there we go. Okay, so anyway, we'll talk about that in just a moment. Let's go through the summary here, and then I'll go through some of these details. So, okay, so PCE inflation, they revised this up. We're going to keep printing money, not expected to stop printing money until they get to their end of their, or soon they say is when they expect to pay a taper. We've got the Fed funds rate projection. This is interesting. Look at this here. They are pricing in a rate increase for the end of 2022. You see this? And then they're pricing in, it looks like potentially two more rate increases here, because the way this usually functions is you would go from 0.0 to 0.1, which is really this range. This is the usual rate increase. Then you would see a rate increase from 25 to 0.5, and it's always these ranges is what you have. So it's not like an individual rate. It's a range that you get. 0.75, I'm sorry, 0.50. 0.50 to 0.75, and then you would see 0.75 to 1. Take a look at this. The Fed actually believes that we'll be here by this 1% number by 2023, this number here. So this is your 2023, and then here, we're going to probably be here by 2022. That's interesting. So kind of moving up their expectations for a rate increase here. That's interesting. Okay, so then we've got, what else do we have here? This is very interesting. So higher inflation expectations, but they're saying inflation's going to go down in 22 and 3. So why then the rate increase in 2022? That's not as exciting. That's one thing I did not want to see, is that rate increase there being priced in 2022. I mean, they're giving us a long-term heads up on it, that, we do want to raise rates, is their expectation. They did raise unemployment slightly here, and this is their reflection of the increase. But notice that did not affect what their opinion is for the following years. See right here, the unemployment rate was boosted a little bit for their projection for 2021 at the end to 4.8, but they did not make any changes to 22 or 23. Okay, that's interesting. All right. So this is their GDP expectation, that GDP is expected to rotate to the downside. And the big range of projections is in 2022 here, in terms of how strong is that market going to be in 22. But you can see the trend here. The trend is very much sort of slowing down and staying up. You're missing that the increase in rate determines the inflation rate. No, it's the other way around. It's inflation determines the interest rate that we use. So let's see what else. Here's the dot plot. Okay, here's dots. So right now we've got quite a few for 2022. Actually, we're at 1, 2, 3, 4, 5, 6, 7, 8, 9. That's 9 for a 2022 increase, with 4, 7, 8, 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 plus what we had over here, 8. We still got more over here though. Yeah, here you've got 8 plus 9 is 17. So you've got 17 folks here. Let me pull up really quickly the last dot plot that we had. So I think that's going to be interesting. Okay, hold on here. Let's pull up summary of economic projections, because they only do these a few times a year. Summary of economic projections. Let's see. Sep. Okay, one sec. We're going to compare 2 months ago. Is this it? No, those are the minute meeting notes. I don't know that I have them. Nope, I don't have them handy. Darn it. All right. Oh, well. That'd be nice. So, okay, what else do we have? So, dots here. I can get these, though. Hold on a sec. I'll pull them up really quick. Federal Reserve, and then we'll compare these. The FOMC for their last one. FOMC, Summary of Economic Projections, PDF. All right. So let's see what we got. Here we go. June. Got them. Okay. And I really want to see their dots. Here's their PDF. Jerome Powell, by the way, speaks in about 19 minutes, so we got a little bit of time. Summary of economic projections, press materials. Now, oh, got it. Here's the June meeting. Okay, cool. So here are the dots for June. So take a look at this. This right here is June. And June had 1, 2, 3, 4, 5, 7. So we had 2 dots move over from raising rates in 23 to raising rates in 2022. Nice. Okay, so we have seen that's roughly what we expected, is to see a few move over. And I do think it's interesting that they're thinking about raising rates here in 2022 by about 0.25%. Okay, these uncertainty about GDP. This is where one place they're looking at uncertainty is GDP growth. We got CNBC mentioning rates expected to hit 1.8% in 2024. I mean, that's similar to what we see here. See, look at that. Here's that 1.8% in 2024, which they did not previously make an estimate of this. But this is also where I've been focused on seeing this earlier rate bump in 2022. Okay. Cool. So let's take a brief listen here to see what the commentary is. I'm going to grab the Bloomberg terminal as well and see what kind of notes we can get here. We've got the Fed coming out in 17 minutes.
Basis points where it was going in. The market is giving the Federal Reserve enormous room here to do what it wants to do, which is to taper without increasing yields. This is a very big development. This is something that has been, I want to call it 6-8 months in the making, where Powell has been trying to get to this point, and he said, I'm going to taper, but he doesn't want to see that reaction in the bond market. I'm looking at Fed probabilities for December. I'm seeing a 48% chance of a rate hike, which is kind of like where it was, even a little bit lower.
Okay. So I did say I was going to talk about my YOLO as well. I've got the terminal rotating up. Okay. So I just bought a call option. I'm tempted to buy some shares as well. But as soon as this taper happened, I bought a call option in actually Hut 8 Mining. That is a Bitcoin mining play. Hut 8 Mining is a Canadian North American miner. They before Bitcoin fell off with this whole Evergrande disaster or issue or whatever, we had this sitting much higher. Look at this. We ran up to $11.34. It's worth noting that it did fall before the Evergrande issue because they issued debt. They were raising some money, which is actually a good thing because they just use that money to buy more Bitcoin miners. But with this news on Evergrande kind of softening, no taper going away, and these expectations of having to raise rates a little bit earlier with the Fed recognizing higher inflation, I think all of these things are just straight bullish for crypto right now. So excited about that. So I'm going for a call option on Hut 8 Mining. If you weren't into options, shares obviously work as well. You don't have to follow me on this. Call options are very dangerous. You could lose a lot of money very quickly. So, just for what it's worth. Looking at crypto, it's worth watching crypto here. You can see as soon as these minutes came out, we started getting a rise in crypto, which absolutely makes sense. It makes sense for multiple reasons. Again, number one, rate increase now projected in 2022, the first one. Then you have 2 more rate increases projected after that in 2023. Then you have the fact that we're still going to be printing money with the Fed recognizing that we have higher inflation and lower jobs growth. It's a perfect catalyst, in my opinion, for crypto to potentially rotate back. Now, no guarantees. Crypto is extremely volatile. The good news is we are at a lower position now than where we were at the beginning of September. Obviously, you could see at the beginning of September, we were at a sort of much more dramatic place when it came to crypto. We were up almost 53,000. And just recently have we really been rotating down off of this. So in my opinion, it's an interesting time here to take advantage of some crypto. Now, interestingly as well, you have Robinhood that announced the crypto wallet. And at the same time, you are seeing Robinhood bounce about 6.8% right now, which in order to sign up for the crypto wallet waitlist, you need to update the app, which I've been trying to update the app, but it wasn't updating for me. So it's just worth mentioning. You got to update the app and then check your email for an email from Robinhood. And then I think you could join the wait list. Did I get it? Okay, I think I finally did it. Let's see here if I can pull up the email and show y'all. Not sponsored by Robinhood, just saying. That's oh, there we go. Open in app. Okay, let's see if it works. Join waitlist. Okay, wow. I got number 256,000. Wow, I was slow. It honestly wasn't like the hugest priority. But anyway, that's the kind of like little excitement you get there. Jump the list by half when you successfully invite your friends. Anyway, Jerome Powell comes out in 12 minutes to come chat with us. So it'll be exciting to see what Jerome Powell is up to. Okay. And yeah, I do want to put it on member chat. I do, but I can't. For some reason, I was having some issues right when we started this live stream. I cannot get the edit window to load on YouTube right now. So we are literally stuck on free chat. I just get pinwheel on the edit window. So I don't know if it's a YouTube problem or what it is, but anywho, let's continue on. I want to also see the Fed statement. So let's pull just the Fed statement here quickly and also see what we've got in Bloomberg. Okay, so this is the actual Fed statement with which Jerome Powell is expected to read to us when he starts. But the Federal Reserve is committed to use its full range of tools. This is the same thing he always says. With progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. Oh, you optimist, Jerome. You optimist. It's awesome. All right. But a rise in COVID cases have slowed the recovery. I don't think many are so terribly anxious about this, but could be wrong. But inflation is elevated, but largely remains transitory. Overall financing conditions remain accommodative, in part reflecting policy measures to support the economy and flow of credit. Path of the economy continues to depend on the curve of the virus or course of the virus. Seek to achieve maximum employment and inflation at a rate of 2% over the long run, with inflation having persistently below this longer run goal. The committee will aim to achieve inflation moderately above 2% for some time. Know this. The committee expects to maintain an accommodative stance on monetary policy, keeping the Fed funds rate at 0 to 1.25%. I'm sorry, 0.25%, and expects it will be appropriate to maintain this until, this is the big key right here, and so everything's going to be really related to that unemployment and those unemployment numbers that come out, specifically the jobs report, which the next jobs report, let's put this on the calendar, jobs report release date, that would be for October. BLS. Let's see here. BLS jobs report. Okay, BLS jobs report comes out October 8th. So it's actually not going to be the first Friday this time. It's going to be the second Friday because the first Friday, it looks like, is on the very first. Let's see here. Okay, so we'll get the report on the 8th. And let's see here. Federal Reserve. Okay, we look at the statement. Until they have reached levels consistent with the committee's assessment. Okay. Last December, the committee indicated it would increase its holdings of Treasury securities by 80 bill per month and MBS by 40 bill until we've made substantial further progress. Since then, the economy has made progress towards these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. So this is the big move here about hey, don't no taper yet that we're expecting. Oh, there we go. No taper yet. That's finally loading. No taper yet, but instead expecting it soon. So we're probably going to see Jerome Powell punt the questions here about when that taper is going to be. My expectation is you're really looking at November 4th as the earliest possibility of a taper announcement. Until then, we've got CPI not coming out until October 13th, jobs report not coming out until October 8th. So you've got a little bit of time. And personally, I think that could lead to even a crypto run. Hut 8 mining, killing it right now. Let's see, BTC, USD, how are we doing? Jerome Powell's going to be talking. Good, and crypto here, Bitcoin still pushing nicely here. Very nice. Here we go. Finally, this darn thing loaded. It's like right when the whole Jerome Powell thing happened, all of a sudden YouTube was pinwheeling, and so is the Federal Reserve. Okay, there we go. All right. So Jerome Powell will be talking about 7 minutes. Excited about that. Watching Bitcoin move nicely here. Did cross over 44,000. Did pull back slightly. Got Ethereum pushed to 3,800. And ADA. Look at that. 225. Let's go. Let's go. That's awesome. That's really good. Oh, that's fun. All right. Okay, cool. So now let's take a peek at the terminal. I want to see what the folks on Wall Street are saying about this. Let's go to them live. All right, here we go. So we've got the FOMC statement is out. Here are the salient points. Dot plot scans a bit hawkish, perhaps. Yeah, that's kind of what we were thinking too. Is really that it seems like people have moved up at the Fed to raising rates sooner. This is what they did in 2018, and it wasn't good. The market had a freak out when rates actually started going up. That was a much more impactful outcome than really just the taper talk. Although you did have the taper tantrum back in 2013. So typically, the more the Fed projects, the less the market is willing to follow suit. Okay, dot plot. We got two members shifting their dot, leaving us with a half a hike median. There was a considerable movement. The median shifted up to 1% in 2023. A lot of dispersion in 2024. Median at 1.75, but a mode or frequency here of 2.125, which is even higher than that 1.75. 7 members think by 2024 we still need to be at 1.125. So actually not increasing. So really a scattering is what Bloomberg here is observing in the dot plot, which in fairness, you see that here. If you actually look at the dot plot, we looked at 22 here and we looked at 23. You can see this beautiful sort of clustering happening here around really one rate increase. You've got a good median over here about increasing to about 1%, but it's harder to identify the median here. Statistically, your median's here, but you have most members voting for a rate increase right around here. So that's interesting. Okay. Median dots for the next 3 years. Okay, I talked about this. Let's see. What else do we have? Okay, scrolling down. Okay, we have gold pushes higher as dollar falls on Fed statement. Yeah, gold pushed up nicely here. The metal climbed 0.5% to 1784 per ounce, short of that 1800 level. Whiplash hits the foreign exchange markets. The euro sets new highs in the minutes after the statement hit, showing traders saw it as both dovish or hawkish in the initial minutes. Oh yeah, you had this crazy bounce. I saw that in the S&P 500. Dollar now at session lows. Okay, yeah, because if the Fed keeps buying, no, that's right. If the Fed keeps buying, that would push prices up and yields down. That makes sense. So the dollar would weaken. That makes sense. The dollar initially climbed, but has now weakened because the Fed's still going to be printing money, which also makes intuitive sense. Yeah, look, I don't think any of us expected bad news from the Fed. I expected more bad news before this Fed meeting. I thought yesterday and like maybe this morning would be worse, but this was expected. We knew they weren't going to taper. I think there's a little bit of bearishness in the tone of raising rates sooner, but I think that's so far out, nobody really cares right now. ADA just bounced to 225, really good. I did a nice trade on my crypto. I sold a bunch of crypto a couple days ago. It was like in the middle of the night too, which I still send alerts to everybody in Stocks and Psychology Money, no matter what time it is. Sorry if I woke anybody. But anyway, I sold all my crypto. And now I've been buying it back and lowering my cost basis, which has been great. But anyway, SoFi is also moving nicely here, 11.34%. Let's just look at the broader market and see how things are moving here. So just did a YOLO on Hut 8 mining. We talked about that. This is the day chart for Hut 8 mining. And this is really, as crypto has been falling, you had a bond offering. Crypto has been falling because of the offering. Now we're kind of hitting that dip. And we've got some nice growth here after the minutes came out. You can see this is really just the reaction. I mean, this morning we had a nice gain here on Hut 8, but then you have this reaction over here after the minutes came out. You've got SoFi up 11.27% on the day. Amazing. Hut 8, 225 there. Hood, 6.41%. Trade Desk, 4.87. Nice on Trade Desk. Here's Bitcoin trying to get to that 44,000 level. Palantir back up about 4%. Good. Looking towards the downside here, we've got Peloton still sitting down about 7.53%. did close my Piton holding, but I do have to say, I closed that a while ago, but I do have to say I was really tempted to pick up some sold puts on this one. Jerome Powell's going to be talking in a moment. So we got about 1 minute to go before Jay Bao comes out to talk to us. Yeah, what else? Yeah, otherwise the market, it seems relatively stable. Let's see, for example, Tesla. How's it? Here's the release of the minutes. Tesla's actually moved up about 0.5% on this news. And the S&P 500 has moved up roughly 0.5% on this news as well. Any thoughts on US SteelX? They've done very well, is my memory of them. But I'm not a commodities expert, I always say. So, okay, 1 minute to go. It's exciting. Yep. Did I ever get up to hood put? I don't have a, you mean a sold put? Let me see. I closed a bunch of Robinhood options the other day. Here we go. Here, see, this is my my Weebs, and my Tesla options are just crying right now, but that's okay. Where is Robinhood? See, here's my firm. There's the AMC. It's the AMC stock down about 13%. Where is my, hold on, is it my Robinhood? Hold on a sec. Give me a second here. Where is it in Robinhood or here? Robinhood, Etsy, Gookip. I don't know if I did my Robinhood here or there. Let me see. Hood. No, it's still up. It's right here. Look. Put it back in here. Hood. So here you go. See, this is the put. This is the October 15th, $42 put. And this thing is up 46%. So I think that's the one you're referring to. Oh, Jay Powell, let's go.
Monetary policy will continue to support the economy until the recovery is complete. Progress on vaccinations and unprecedented fiscal policy actions.
This is him, of course, reading the statement.
Support to the recovery. Indicators of economic activity and employment have continued to strengthen. Real GDP rose at a robust 6.4% pace in the first half of the year, and growth is widely expected to continue at a strong pace in the second half. Sectors most adversely affected by the pandemic have improved in recent months, but the rise in COVID-19 cases has slowed their recovery. Household spending rose at an especially rapid pace over the first half of the year, but flattened out in July and August as spending softened in COVID-sensitive sectors, such as travel and restaurants. Additionally, in some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production. Partly reflecting the effects of the virus and supply constraints, forecasts from FOMC participants for economic growth this year have been revised somewhat lower since our June summary of economic projections, but participants still foresee rapid growth. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and job gains averaged 750,000 per month over the past 3 months. In August, however, job gains slowed markedly, with the slowdown concentrated in sectors most sensitive to the pandemic, including leisure and hospitality. The unemployment rate was 5.2% in August, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs and ongoing fears of the virus, appear to be weighing on employment growth. These factors should diminish with progress on containing the virus, leading to more rapid gains in employment. Looking ahead, FOMC participants project the labor market to continue to improve, with the median projection for the unemployment rate standing at 4.8% at the end of this year and 3.5% in 2023 and 24. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower wage workers in the service sector and on African Americans and Hispanics. Inflation is elevated and will likely remain so in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term.
Yep.
These bottleneck effects have been larger and longer lasting than anticipated, leading to upward revisions to participants' inflation projections for this year.
Yep.
While these supply effects are prominent for now, they will abate. And as they do, inflation is expected to drop back toward our longer run goal. The median inflation projection from FOMC participants falls from 4.2% this year to 2.2% next year. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could again prove to be greater and longer lasting than anticipated, posing upside risks to inflation. Our framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of longer-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If sustained higher inflation were to become a serious concern, we would certainly respond and use our tools to assure that inflation runs at levels that are consistent with our goal. The path of the economy continues to depend on the course of the virus, and risks to the economic outlook remain. The Delta variant has led to significant increases in COVID-19 cases, resulting in significant hardship and loss, and slowing the economic recovery. Continued progress on vaccinations would help contain the virus and support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. Since then, the economy has made progress toward these goals. If progress continues broadly as expected, the committee judges that a moderation in the pace of asset purchases may soon be warranted. We also discussed the appropriate pace of tapering asset purchases once economic conditions satisfy the criterion laid out in the committee's guidance. While no decisions were made, participants generally view that, so long as the recovery remains on track, a gradual tapering process that concludes around the middle of next year is likely to be appropriate.
That's a big one.
Even after our balance sheet stops expanding, our elevated holdings of longer-term securities will continue to support accommodative financial
It's about a 6 to 8 month taper.
The timing and pace of the coming reduction in asset purchases will not be intended to carry a direct signal regarding the timing of interest rate liftoff, for which we have articulated a different and substantially more stringent test. We continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. Half of FOMC participants forecast that these favorable economic conditions will be fulfilled by the end of next year. As a result, the median projection for the appropriate level of the federal funds rate lies slightly above the effective lower bound in 2022. Participants generally expect a gradual pace of policy firming that would leave the level of the federal funds rate below estimates of its longer run level through 2024. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. More important than any forecast is the fact that policy will remain accommodative until we have achieved our maximum employment and price stability goals. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you, and I look forward to your questions.
All right. Just a quick note, the big takeaway there was concluding the taper the middle of next year. That was the big takeaway. We're going to get to questions now. This is big.
When it comes to the taper and eventually to any rate increases, I'm wondering if you can walk us through what substantial further progress looks like, given the latest batch of projections that have Pce inflation coming in a little higher than the June projection, the unemployment rate also being higher than June, as well as the change to GDP lower than June. If you could help us make sense of all those things as you sort through what substantial further progress looks like, that would be great.
Sure. So the test for beginning our taper is that we've achieved substantial further progress toward our goals of inflation and maximum employment. And for inflation,
crypto's falling a bit right now on this.
Achieved more than significant progress, substantial further progress. So that part of the test is achieved in my view and in the view of many others. So the question is really on the maximum employment test. So if you look at a good number of indicators, you will see that since last December when we articulated the test and the readings today, in many cases, more than half of the distance, for example, between the unemployment rate in December of 2020 and typical estimates of the natural rate, 50 or 60% of that road has been traveled. So that could be substantial further progress. Many on the committee feel that the substantial further progress test for employment has been met. Others feel that it's close. They want to see a little more progress. There's a range of perspectives. I guess my own view would be that the substantial further progress test for employment is all but met. And so once we've met those two tests, once the committee decides that they've met, and that could come as soon as the next meeting, that's the purpose of that language is to put notice out that could come as soon as the next meeting.
That's November 4th.
The committee will consider that test, and we'll also look at the broader environment at that time and make a decision whether to taper.
Thank you. We'll go to Howard Schneider.
Thanks, Chair Powell. Thanks, Michelle. So looking at the steps, we have now basically 4 years of inflation above target, and policy never gets to the long run rate. I'm wondering if you could address that from two perspectives. One, within the new framework that the Fed adopted last year. And second, from the perspective of the average household that's now being asked to pay higher prices and increasingly higher prices for 4 years running, when for some this year, real wages have actually gone down.
Sure. So as you can see, the inflation forecasts have moved up a bit in the out years. And that's really, I think, a reflection of, and they've moved up significantly for this year. And that's, I think, a reflection.
Crypto's falling on this. Look at this.
At the bottom.
It's not good for YOLO.
That we're seeing in the economy have really not begun to abate in a meaningful way yet. So those seem to be going to be with us at least for a few more months and perhaps into next year. So that suggests that inflation.
Stop talking, Jerome.
a number, I guess the inflation rates for next year and 2023 were also marked up, but just by a couple of tenths. Those are very modest overshoots.
Look at that. S&P down too.
2.1. 2 years and 3 years out. These are very, very. I don't think that households are going to notice a couple of tenths of an overshoot. That just happens to be people's forecasts. We want to foster a strong labor market, and we want to foster inflation averaging 2% over time. And I think we're very much on track to achieve those things. In terms of the framework, I see this as very consistent with the framework. We want inflation expectations to be anchored at around 2%. That's really the ultimate test of whether we're getting this done under the framework. And we do want inflation to run moderately above 2%. I wouldn't put too much on a couple of tenths over 2% in 2023 and 24. 1/10 in 24. But you're right; those are the numbers.
Thank you. Let's go to Colby Smith.
Chair Powell, thank you, Michelle. Chair Powell, you mentioned ongoing discussions about the tapering timeline, and I'm wondering what the contours of that debate have been. For those that want to move a bit more quickly, is it about maintaining optionality for a 2022 interest rate increase, or is it about financial stability risks or concerns about the efficacy of asset purchases at a time when we have supply constraints? Thank you.
So let me say that there's very broad support on the committee for this plan, both as to the timing and as to the pace of the taper. So this was a unanimous vote today, and I'd say quite broad support for this approach.
Unanimous.
You're correct that there are some who would prefer to have gone sooner, and they've made their arguments publicly. For some of them, it's a financial stability concern, and for others, it's other concerns. They can make their own arguments. This is an approach that the committee will broadly support, and it will put us, having completed our taper sometime around the middle of next year, which seems appropriate. The asset purchases, as I mentioned, were very, very important in the early stages of the crisis. They were essential in restoring market function in the Treasury and other markets. Then, as the recovery got going, they supported aggregate demand, as they will do. And now we're in a situation where they still have a use, but it's time for us to begin to taper them. Their usefulness is much less as a tool than it was at the very beginning. Yep. And of course, this leaves the whole question of rate increases ahead, which is really where the framework is all about, how we deal with rate increases and that sort of thing. So we think this is the appropriate way to go. And
he's calling bond purchases a lot less useful. So now S&P's falling again.
Thank you. We'll go to Nick Timrose.
Stop dogging.
Hi, Nick Timrose of the Wall Street Journal. Chair Powell, you have said the test for liftoff is more stringent than the test for tapering. But if the near-term projections today are credible, more of your colleagues seem to think that rate liftoff and not just a taper may be closer at hand. Does the committee have a different opinion than you do about the threshold?
He's crashing in the market
that you've articulated, or do they believe that either inflation or economic growth will necessitate a rate increase sooner than you do?
Well, so again, substantial further progress toward our goals is the test for beginning the taper. And the taper takes some months in everyone's figuring. So you're going to be well away from satisfying the liftoff test when we begin the taper. So in terms of the liftoff test, though, it's what we adopted last September. It's labor market conditions consistent with maximum employment. And while we have interesting signs that in many ways the labor market's very tight, we also have lots of slack in the labor market, and we think that those imbalances will sort themselves out. Inflation at 2% and on track to achieve moderately higher inflation over 2%. That really depends on the path of inflation. If inflation remains higher during the course of 2022, then we may already have met that test by the time we reach liftoff. So I just think if you look at what people are writing down for year-end 2022 numbers, some people are writing down very low unemployment rates, and that's only one indicator, but it suggests a very strong labor market. And I think they're writing down in good faith what they see as meeting the test. There's a range of perspectives about where the economy will be, but by the way, all but one participants have us lifting off during 2023. So it's not really an unusually wide array of views about this.
Lifting off, by the way, refers to interest rates going up. Like the rocket ship.
We'll go to Gina Smihalek.
And he's right. You could see right here, all but one. Oops. See rates going up until 2024.
Were you aware of the kind of security buying and selling that Presidents Kaplan and Rosengren were participating in last year? And I wonder if you thought those were appropriate.
Okay, this is a boring question.
So, no, I was not aware of the specifics of what they were doing. So let me just say a couple things about this subject. We understand very well that the trust of the American people is essential for us to effectively carry out our mission. And that's why I directed the Fed to begin a comprehensive review of the ethics rules around permissible financial holdings and activity by Fed officials. So those rules are in many respects the same as those for government agencies, plus a number of things that apply specifically to us because of our business. One of those is there's sort of three things I would point to in terms of specific restrictions. One is ownership of certain assets is not allowed, and that's bank securities and other things. Secondly, there are times when we're not allowed to trade at all or to buy and sell financial assets, and that's the period immediately before and during an FOMC meeting. And third, there's regular disclosure. So all of these, everyone's ownership and activities are all disclosed on an annual basis. So I would have had to go back and read people's financial disclosures to know what their activities have been. This has been our framework for a long time. And I guess you'd say it's served us well. The other thing you would say, that it is now clearly seen as not adequate to the task of really sustaining the public's trust in us. We need to make changes, and we're going to do that as a consequence of this. This will be a thoroughgoing and comprehensive review. We're going to gather all the facts and look at ways to further tighten our rules and standards.
Bitcoin don't like it. Bitcoin don't like it at all.
Go to Steve Leisman.
Thank you. Thank you, Mr. Chairman. I want to follow up on Gene's question.
Rocket landing.
The issue of ownership of these stocks and trades. Do you think it's appropriate for Federal Reserve officials to be owning the same assets that the Federal Reserve is buying? Is that one of the modifications that you're looking at? And in that, you said yourself they don't clearly not seen as appropriate. In that, the Fed's code of conduct says Fed officials should avoid even the appearance of conflict. Do those trades, in fact, and holdings violate the Fed's code of conduct? Finally, do you have a timeline as to when you might get done with your review? Thank you, sir.
Don't have a timeline yet. We can start with that. Well, let me address the muni question, since that's in there. I personally owned municipal securities for many years, and in 2019 I froze that, meaning I'm holding all those securities, my wife and I, to maturity, and munis were always thought to be a pretty safe place for a Fed person to invest, because as you know, the lore was that the Fed would never buy municipal securities, so it was not an uncommon thing. And so then comes the COVID crisis, and I reversed that policy, and I did it without hesitating. And the reason was that the financial markets, and including the municipal financial market, were very much on the verge of collapse, and it was time to go, and we did. But we also checked with the Office of Government Ethics, and who looked carefully at it and said that I didn't have a conflict. So that's one answer that I wanted to share with you. Secondly, you're right, though. We're going to be looking at all of those things. I don't want to get ahead of the process here and speculate about particular outcomes. But this, again, comprehensive and deliberate process. We're going to make changes. I want to be able to look back on this years from now and know that we rose to meet this challenge and handled the situation well, and that what we did made a lot of sense and protected the public's interest and the institution that we're all.
Yawn. Sorry.
I'm sorry, Chair Powell.
Like them talking about the ethics stuff. It's important. I get it. I just think they should have immediate disclosure. If you're going to trade stuff, disclose it instantly. That's what I do in Stocks and Psychology of Money. That's what they should do as politicians.
I mean, it was a real coincidence. I happened to pre-own these munis. They were bought many years ago, actually. And
but see, now we're wasting time talking about this. We should be talking about that taper.
It was really not it just was an unforeseen event, and I couldn't sell them. So what I did was I just held them, checked with the ethics people, and went ahead. So, but it's a general principle. Yeah, that makes a lot of sense.
Thank you.
Thank you. We'll go to Chris Vergaber.
Thank you. Thank you, Chair Powell. Well, I had a question about jobs and the Fed's schedule, the Fed's policy framework that you laid out here. You and other Fed officials have often talked about expecting a job market pickup in September as more children return to school, freeing up more parents to work. COVID abating. You mentioned in the past the extra unemployment benefits expiring. There's some real-time data suggesting that we may not be seeing much of a return of labor supply. So do you still expect to see that in the next couple of jobs reports? And how would a relatively weak jobs report in September affect your plans? Thank you.
So you're right. We have a really, I'll call it a unique situation where by many measures, the labor market is tight, and 11 million job openings, very widespread reports from employers all over the economy saying it's quite difficult to hire people, wages moving up and that kind of, so quite a tight labor market. So our view, I think widespread view a few months ago was that several things were coming together in the fall, including kids back to school, which would lighten caregiving duties, including the expiration of extra unemployment benefits, and other things would come together to provide an increase in labor supply. And so we'd get out of this strange world where there are lots of unemployed people and a high unemployment rate, but a labor shortage. And so what happened was Delta happened. And you have this.
Look at gold. Ran, leveled, crashed. This is called Jerome Powell talking.
When schools are open 60% of the time, or when they're always at a threat of being closed because of Delta, the Delta variant, you might want to wait rather than going ahead and taking a job and starting work only to have to quit it 3 weeks later. You're going to wait until you're confident of that. So some of that may not have happened. Also, people didn't, as you know, hiring and spending in these face-to-face service industries, travel and leisure, it just kind of stopped during those months. So that really the big shortfall in labor in jobs was largely in travel and leisure, and that's because
he said the big short
because of Delta. So that all happened, and so what we know is that it didn't happen. I think there's still it may just be that it's going to take more time, but it still seems that inexorably these are people who were largely working back in February of 2020. They'll get back to work when it's time to do that. It just may take longer time. You're right, though. It didn't happen with any force in September, and a lot of that was Delta. In terms of you asked also about the test for November. I think if the economy continues to progress broadly in line with expectations, then I think also the overall situation is appropriate for this, then I think we could easily move ahead at the next meeting, or not, depending on whether we feel like those tests are met.
Well, if I just quickly follow up, I mean, how much of that will depend on what kind of jobs report we get for September? And I mean, is it, are you in a data-dependent phase here where you need to see certain numbers going ahead, or are we at a point where you've accumulated enough progress that?
So it's accumulated progress. So, for me, it wouldn't take a knockout, great, super strong employment report. It would take a reasonably good employment report for me to feel like that test is met. And others on the committee, many on the committee feel that the test is already met. Others want to see more progress, and we'll work it out as we go. But I would say that in my own thinking, the test is all but met. So I don't personally need to see a very strong employment report, but I'd like to see a decent employment report. I mean, it's not to be confused with the test for liftoff, which is so much higher.
Great, thank you.
Okay, thank you. We'll go to Victoria Guida.
Hi, Chair Powell. So I wanted to ask about the Vice Chair of Supervision position, and I was wondering if you could speak about how you view that role and the extent to which you defer to that person on regulatory policy. And then just sort of a related question, as you know, Randy Quarles' vice chairmanship ends next month. And I was wondering if he's going to retain the supervisory portfolio until he's replaced in that role.
Sure. So Dodd-Frank created this position, Vice Chair for Supervision, and there's actually a specific assignment in the Dodd-Frank language, as I'm sure you know. And effectively what it means is that the Vice Chair for Supervision is charged with setting the regulatory agenda. And it's a specific grant of authority. And in the 10 years almost that I've been at the Fed, that person has really done that. Dan Tarullo certainly did it, and Vice Chair Quarles did it as well. And I would, I think I respect that authority. I respect that. That's the person who.
Bitcoin continues to fall. And I believe the SPY's also been trending in that direction.
To look at for a new person to come in and look at the current state of regulation and supervision and suggest appropriate changes, and I welcome that. In terms of Vice Chair Quarles' term, we're not currently in that situation, and I actually don't have any updates for you on that today. We'll keep you posted on that.
Thank you. We'll go to Steve Matthews at Bloomberg.
Thank you. Chair Powell, I wanted to ask about the inclusive monetary policy framework. In particular, Bloomberg surveyed economists, and we found that they predict liftoff will happen when the U.S. unemployment rate is 3.8%, but the Black unemployment rate is 6.1%. Now, I'm wondering if a 6.1% unemployment rate for African Americans is consistent with full employment, or whether it would need to be lower as part of your inclusive growth strategy.
Right. So the point of the broad and inclusive goal was not to target a particular unemployment rate for any particular group. Really, we look at a broad range of a very broad range of metrics when we think about what maximum employment is. And one of the things we look at is unemployment rates and participation rates and wages for different demographic and age groups and that kind of thing. So we will do all of that. So I think if you look back, what were we really thinking? So we all saw the benefits of a strong labor market. If you look at the last 2 or 3 years of before the pandemic hit, you saw, after a lot of long progress, you saw a really strong labor market, and you saw wages at the low end moving up faster than everywhere else, something that's great to see. We also saw the lowest unemployment rates for minorities of various, for African Americans, for example, and also participation rates. I mean, we saw a really, really healthy set of dynamics. And by the way, there was no reason why it couldn't continue. There were no imbalances in the economy, and then along came the pandemic. There was nothing in the economy that looked like a buildup of imbalances that could cause a recession. So I was very much thinking that the country would really benefit from a few more years of this. It would have been great. And so we're all quite eager to get back to that. We also said we wouldn't raise rates just in response to very low unemployment in the absence of inflation. So that was another aspect of it, because we saw that really benefited labor market participants in a broad and inclusive way. That's, of course, not the current situation. We have significant slack in the economy, well above target, not moderately above target. So that's really how we think about it. It isn't really just targeting the headline numbers, but it's about taking all of those things into account in your thinking about what constitutes maximum employment.
I guess just to follow up, should there be a significant gap between Black unemployment and overall unemployment for structural reasons that are outside of the control of the Fed that other people should be doing something about? Or should the gap be narrowed, if not down to zero?
Well, first of all, ideally, there wouldn't be any gap. Of course, we'd all love to see no such gap. This is a persistent gap, and it's very hard to explain based on typical metrics. It's quite troubling, but it really is. We have famously broad and blunt tools. I think eliminating inequality and racial discrimination, racial disparities, and that kind of thing is really something that fiscal policy and other policies, frankly, education policies and that kind of thing, are better at focusing on. I think we've identified the part that we can do, and we'll do that part. But I've always been clear that it's going to take policies broadly across society to work on these problems.
Thanks.
Thank you. Let's go to Michael McKee.
He's right. I'll do a summary too in a bit.
Michael, for dealing with a debt default that included prioritization, that included changes in bank regulations, and possibly selling defaulted or non-defaulted treasuries and buying those who are that are. Are any of all of those still on the table? Do you think any of those would work? And what would happen to the economy, in your view, should the debt ceiling not be raised?
So I missed the first few words, but I think I got your question. So it's just very important that the debt ceiling be raised in a timely fashion so that the United States can pay its bills when and as they come due. That's a critically important thing. The failure to do that is something that could result in severe reactions, severe damage to the economy and to the financial markets, and it's just not something that we could contemplate. That we should contemplate. I'm not going to comment on particular tactics or things like that. I'm just going to say that I think we can all agree that the United States shouldn't default on any of its obligations, should pay them when and as due, and that no one should assume that the Fed or anyone else can protect the markets or the economy in the event of a failure, fully protect in the event of a failure to make sure that we do pay those. That's when they're due.
Good. If I could follow up, have you discussed options with members of Congress?
I don't generally ever talk about the conversations I have with elected officials or other appointed officials. But look, you can see that this is a major focus among those who have responsibility for it, and including elected people.
Thank you. Let's go to Hannah Lang.
Not my job.
Hi, thanks so much. Senator Warren sent you a letter last week urging the Fed to break up Wells Fargo, citing what she called ungovernable behavior from the bank. I was just curious, under what circumstances would the Fed actually consider revoking a financial holding company's license, and if the indiscretions at Wells Fargo, in your opinion, warrant such an action?
So we're, of course, very closely monitoring Wells Fargo's efforts to fix its widespread and pervasive problems. They represent a serious matter to us, and the firm is required to remediate them. And we will take appropriate supervisory action if the firm fails to meet our expectation. We continue to hold the firm accountable for its deficiencies with an unprecedented asset cap that will.
What do they have wrong with the firm?
The firm has comprehensively fixed its problems. We're not going to remove that asset cap until that's done. So bottom line is we'll take strong supervisory action if a firm is engaging in unsafe and unsound practices or violating
Why
laws.
you got to bag on a
I can't
firm?
speak to our confidential supervisory assessments of any individual bank.
Doesn't it seem like he's unfairly bagging on a firm? Just kidding. In case anybody doesn't realize, he's talking about Wells Fargo, a firm named Wells Fargo. Gosh.
In the press conference that you weren't aware of the trading activity of the Boston and Dallas Fed bank presidents. As you know, all 12 regional Fed bank presidents just went through the renomination process earlier this year, and Governor Brainerd described it as a rigorous process at the time. So I want to know, did anybody at the board level know about the stock trading activity? And going forward, do you still have confidence in the Dallas and Boston Fed bank presidents to do their job?
So these, I don't need to tell you, people file these reports annually, and I think they were just quite recently filed for 2020. So I don't have any reason to think people at the board would have known about particular trading that's going on. They will see that there are people at the Fed who see that see the trading reports when they're annually filed. In terms of having confidence in that sort of thing, I think no one is happy. No one on the FOMC is happy to be in this situation, to be having these questions raised. It's something we take very, very seriously. This is an important moment for the Fed, and I'm determined that we will rise to the moment and handle it in ways that will stand up over time. I'm very reluctant to get ahead of the process and speculate, though, about about different things. And, when we have things to announce, we'll go ahead and do that. But that's really what I have for today.
One small follow-up. I mean, I know that you didn't have the 2020 forms in hand, but you would have had past year forms in hand. And at least in the case of like the Dallas disclosure forms, similar trading activity was shown in years past. So that in theory could have been something that came up in the renomination process.
So that's a good question. So, the 5-year review that we do under this unusual provision of law where all of the Reserve Bank presidents are reviewed for reappointment at the same time every 5 years. That is really a broad review about their leadership of the institution, their performance on the FOMC, all of those things. And if there were a concern, a public concern or a private concern about something that someone had done, we wouldn't wait for the 5-year. We wouldn't wait that day if there were concerns. You're right though. These, as I mentioned, we have had a framework for a long time, and it's similar to what other government agencies have. Only it's a little stricter, and it is that you can trade financial instruments, but not specific ones like bank debt. You can't trade during the FOMC period and during the meeting, the blackout period, and then during the meeting. And then you disclose all this. And we have disclosed it for years. So all of these things have been going, they've been a matter of public record. But nonetheless, so that, it was seeming to work just okay. And now you look at it and you see this and you think, we need to do better, and we will. But you're right. But it has not been part of the process, and appropriately, I don't think it should have been. I mean, I wouldn't blame the people who conduct that review. I really think if someone had raised concerns or if we'd had concerns, then it would have been, but it wouldn't have been part of that process. It would have been raised instantly rather than once every 5 years.
Thank you.
Not it.
Thank
I'll
you.
do a
Let's go to
summary.
Gene Young.
No, one more.
Thank you, Michelle. Chair Powell, I wanted to ask about how the Fed would balance the two parts of its dual mandate. If inflation stays elevated, but we still have a labor shortage and participation remains lower than ideal, would you hold off on raising rates, or how would you think about that?
Well, let me say one thing. You're looking for conditions consistent with maximum employment, and those conditions can change over. So you're not necessarily bound by a particular level of the unemployment rate or the participation rate or anything else like that, which can change over time. But more to your point, really, we actually have a paragraph in our framework, and something like this has been there for a long time. I think it's paragraph 6. And you're talking about a situation in which the two goals are not complementary. They're somehow in tension. And if we judge that is the case, what it says is we take into account the employment shortfalls and inflation deviations and the potentially different time horizons over which employment and inflation are projected to return to levels judged consistent with mandate. So we used to call that the balanced approach paragraph because it had those words. So it's a very difficult situation for any central bank to be, to be in a situation where the two goals are in tension. And that paragraph tries to address it by saying we would sort of weigh the equities between the two. How long will it take, and how big are the gaps, and that kind of thing. We don't really think we're in that. We're sort of in that situation, I'd say, in a short-term way. But we think we do expect that that this is sort of a because of the COVID shock and the reopening and all that, you're seeing this temporarily.
Great. Thank you. We'll go to Edward Lawrence.
Should be the last question.
Thank you, Michelle. Thank you, Mr. Chairman, for taking the question. So on corporate debt, what happened with Evergrande that we've been watching, is that a preview of what could happen with the amount of corporate debt that's out there. In the past, you said you're watching the level of corporate debt. So what's your level of concern right now? And would you consider the Evergrande Group issue a sort of a warning signal?
About the United States? No. Corporate defaults are very low in the United States right now. Corporate leverage built up over the course of the long expansion that ended with the pandemic. We were very concerned in the last year or so. We were concerned in the last year or so, and then I'd say very concerned at the beginning of the pandemic that if you've got a highly leveraged company and your revenue stops for an uncertain period as things happened at the beginning of the crisis. We were very concerned that there would be a wave of defaults. It didn't happen, potentially, I mean, to a significant extent because of the CARES Act and the response that we undertook and all that. It was a much stronger response than we've ever had. And I think for whatever reason now you have very, very low default rates now among corporate debt. The Evergrande situation, it seems very particular to China, which has very high debt for an emerging market economy, really the highest that any emerging market economy has had. And the government has been working to get that under control. This is part of that effort. The government put new strictures in place for highly leveraged companies, and Evergrande is dealing with those strictures, and it's something they're managing. In terms of the implications for us, there's not a lot of direct United States exposure. The big Chinese banks are not tremendously exposed, but that you would worry that it would affect global financial conditions through confidence channels and that kind of thing. But I wouldn't draw a parallel to the United States corporate sector.
Thank you. We'll go to Brian Chung.
Hi, Chairman Powell. Just wondering if you could give us an update on whether or not you've had conversations with the White House about a possible reappointment, and then whether or not you would like to be reappointed as this chatter kind of builds up. Thanks.
I think the phrase goes, I have nothing for you on that today. Sorry. I'm focused on doing my job, every day for the American people, and I don't have any comment on that, Brian.
Sorry about that. Let's go to Greg Robb.
Cut him off.
Thanks for taking my question, Chair. I was wondering if in your discussion about the tapering, that you said that officials think it's appropriate to end around the middle of the year. If there was any discussion about what happens to the balance sheet, then I've heard some Fed officials say that they would shrink the balance sheet. Was that discussed, and what's your stance on shrinking the balance sheet? Thanks.
So my thinking on this has been, let's get through the taper decision, and then let's turn to those issues. There are a number of related issues. You mentioned one, Greg, but and which you need to start to think about, and we'll do that. But we want to get through this taper decision and then turn to those issues, rather than start thinking about them now and having the minutes discuss them and get people thinking that we are focused on those issues, because we're really not. And we do have the experience of what we did last time. We've watched other countries and what they've done. So I think we'll be able to get to sensible decisions fairly expeditiously when it's time, but it's just not time yet in my thinking.
Thank you.
Thank you. Let's go to Scott Horsley.
CNBC.
Thank you, Mr. Chairman. You talked a little bit about inflation expectations, and there does seem to be something of a divide between market expectations and the views of professional economists, which are pretty much in line with the FOMC members, and lay people's expectations, at least as reflected in the recent New York Fed survey. How much weight do you put on lay people's expectations, and what do you think accounts for that divide?
So within, let's just take the household surveys generally. The New York Fed survey, let me talk about that specifically, and this is from the New York Fed. It's only an 8-year-old survey, and it does seem as though they're looking 3 years out, and it seems like there's a high correlation between 3 year and 1 year. For the most part, surveys are showing that households expect higher inflation in the near term, but not in the longer term. And that's also what expectations are showing. So there are many, many different inflation measures, of course, and that's why we have the CIE, which is it's an index of it's market-based measures, it's professional forecasters, and it's household surveys. And you just put them all, it's not, it doesn't have a lot of grand theory about it. You put them all in and you measure the change. So you should be, and also you measure things like the dispersion and that sort of thing. So you can look at all of that, and it tells a story of inflation expectations moving up. Many of the different measures will also show inflation expectations moving back up to where they were in, say, 2013, which was before the really drop in inflation expectations broadly happened in 14 and 15 around then. So that's not a troubling thing. But, inflation expectations are terribly important. We spend a lot of time watching them. And if we did see them moving up in a troubling way and running persistently above levels that are really consistent with our mandate, then, we would certainly react to that. But we don't really see that now. We see more of a moderate increase that is in the first part of which is welcome. And because, inflation expectations had drifted down, and it was good to see them get back up. Again, we watch carefully.
Thank you. Let's go to Heather Scott.
There's so many of them today. Let's go.
Hi, sorry. You caught me off guard.
Yeah.
Thank you, Chair Powell, for taking my question. I really appreciate it. Again, on
looks so chill.
Timing, you say it's going to last till the middle of next year, but with your concerns about the potential for upside risks to inflation, would you think you might need to have liftoff happen before you finish the tapering?
That's not my expectation. Of course, we can always. We haven't decided to taper yet, and we haven't decided the pace yet.
That was a good answer, by the way. That was smart. She just Trojan horsed him. She got him to say no rate increase before the middle of the summer. That's big.
We can certainly speed up or slow down the taper if it becomes appropriate, though. Absolutely. In fact, back in 2013 when we tapered, we always said we weren't on a preset course. I think this will be a shorter period. The economy is much farther along than it was when we tapered.
She got him.
In 2013, so it makes sense to allow the runoff to happen. It's a very gradual taper. It will be when we agree on it, and but we certainly have the freedom to either speed it up or slow it down if that becomes appropriate.
She was smart, though. You might make fun of her, but she was smart.
To happen until you're finished with that process.
It wouldn't. No, because when you're as long as you're buying assets, you're adding accommodation, and it wouldn't make any sense to, then lift off. I mean, what you would do is you'd speed up the taper, I think, if that were the situation you're in. We don't expect to be in that situation, but I do think it would be wiser at that point to go ahead and speed up the taper, just because the two are then working in the same direction.
Great, thank you.
Thank you.
Good one.
Okay,
Best
for the
question
last
so far.
We'll go to Jeff Cox.
Last question.
Thank you, Mr. Chairman, for taking the question. I just wanted to check in with you to see if you have an update at all.
Watch it pump of crypto once, so there's no more bad news.
Currency. I believe that the report was supposed to come this summer, and indications that it's going to come this month. But the drumbeat seems to be kind of getting louder to see where the Fed's heading on this, and just wondering if you can provide some update there.
Sure, I'd be glad to. So we think it's really important that the central bank maintain a stable currency and payment system for the public's benefit. That's one of our jobs. We also live in a time of transformational innovation around digital payments, and we need to make sure that the Fed is able to continue to do a stable and trustworthy currency and payment system. So there's extensive private innovation, a lot of which is taking place outside the regulatory perimeter, and innovation is fantastic. Our economy runs on innovation. But where the public's money is concerned, we need to make sure that appropriate regulatory protections are in place. And today they really are not in some cases. So with that in mind, and with the creation of myriad private currencies and currency-like products, we're working proactively to evaluate whether to issue a CBDC, and if so, in what form. We have two broad work streams, one of which is really technology, both at the board and in the Federal Reserve Bank of Boston's work with MIT. The other of which is to identify, scope out, deal with, analyze the various public policy issues. As you mentioned, we do intend to publish a discussion paper soon that will be the basis for a period of public engagement with many different groups, including elected officials around these issues. We think it's our obligation to do the work both on technology and public policy to form a basis for making an informed decision. The ultimate test will apply when assessing a central bank digital currency and other digital innovations is, are there clear and tangible benefits that outweigh any costs and risks? We're also, as you know, investing heavily right now in building a new settlement system for instant payments in the U.S. It'll be the first such major expansion of our core payment system
Wow.
since the 1970s. We found the case for this quite compelling for consumers, businesses, and just ensuring that all financial institutions have access to the payment system. So bottom line, we haven't made a decision about the CBDC, but we will be issuing a discussion paper soon in order to form the basis of this public interaction that we'll have. Thank you very much.
Here we go.
Can I get a quick follow on that? Thank you.
Jerome's face is like, oh, hell no.
Are you concerned at all with kind of falling behind in the global race for digital currency?
I think it's important that we get to a place where we can make an informed decision about this and do so expeditiously. I don't think we're behind. I think it's more important to do this right than to do it fast. We are the world's reserve currency, and I think we're in a good place to make that analysis and make that decision. By the way, which will be a government-wide decision. We would do this. We would have to have a meeting of the minds with the administration, and also probably with Congress. We would really like to have broad support for this. It's a very important innovation, and I think we would need that to go ahead, and that's the process we're engaged in. Thanks very much.
Jeff Powell very important innovation.
Press conference there.
All right, folks, let's do a summary on what the heck Jerome Powell just said, and then we're gonna go look at the sticks. Well, I'll tell you, look at them sticks going right back up. I like looking at that. All right, good. Okay, so wow, a lot said here. Okay, let's do a summary of everything that Jerome Powell just said. Okay, I'm gonna start it like it's a new video. Wait for it. I kind of screwed it up again. Whatever, it's good enough. Who cares? Okay, y'all ready? All right, let me lower this crap. Hold on a sec. It's killing me. All right, here we go. Listening to myself too loudly is kind of annoying. All right, here we go. Hey everyone, me Kevin here. So we just heard from Jerome Powell that we will not be raising rates and we will not be tapering at the FOMC meeting. Instead, we're expecting Jerome Powell to potentially taper November 4th. In fact, Jerome Powell told us that there is a unanimous decision that has been made and that the entire committee unanimously agrees that we will start tapering, that we will end the taper by the middle of next year. That taper has not begun yet, but we expect that to begin November 4th, unless there is some kind of shocker to the downside. Shocker to the downside would have to probably be a very bad unemployment report or jobs report. Jobs report comes out on October 8th, I believe it is. I'm going to have to double check that one. I believe it's October 8th for the jobs report because it's the second Friday of October, since the first Friday falls on the 1st. It's the 8th. And then we've got CPI figures coming out on October 13th. And we don't have the Fed all the way until November 4th. So those two reports are going to probably be that final kind of nail in that decision to taper November 4th. We expect the taper to complete within about 7 months by the middle of 2022. That's a faster pace than usual. And initially, when we heard no taper yet, and we heard moved up, we saw the S&P 500 and crypto move up. As soon as Jerome Powell said that we would taper by the middle of 2022, markets pulled back. And that's because previously we've taken about a year to taper from 120 billion in asset purchases, what we're doing now, to zero, whatever it was before, to zero. Now, Jerome Powell and the committee are talking about doing it as quickly as 7 months. So that is actually a hawkish tone. That's suggesting that there's potentially more upside to inflationary risks and it's time to taper. Now, one of the media folks asked a very astute question. She said, hey, are you going to raise rates before you finish tapering? And the reason she asked that question is because in the summary of economic projections, which came out, we actually had a little bit of a change. We had a shift. Right here at the bottom, you're going to see the Fed funds rate. You see this 0.3 right here above that green I just drew? This 0.3 right here is a sign that the Federal Reserve wants to have interest rates bump at least one time in 2022, and then the median forecast is for 2 more bumps in 2023. But this begs the question right here, okay, Jay Powell and friends, when are you going to increase rates? Are you going to do this first bump from 0.0 to the range of 0.0 to 0.25? Are you going to bump this to 0.25 to 0.50 at the beginning of 2022 or at the end of 22? She had a very, very smart question, because when Jerome Powell responded, he kind of reacted quickly to that. And he reacted quickly to that because he's like, no, basically, I'm summarizing here. It's like, why would we do that? That would be like contradictory. You can't raise rates and taper at the same time. We would have to finish the taper and then raise rates. And by saying this, Jerome Powell signaled to markets that we're not going to see a rate increase until the very earliest, the second half of next year, unless, of course, things change. And that's where, naturally, Jerome Powell kind of walked that back a little bit because he got caught real nicely. So he walked that back a little bit and of course, said, hey, unless, of course, things change, then we would modify our actions. Now, Jerome Powell talked a bit about the maximum employment test and substantial further progress. He believes that almost everybody believes that we've met the substantial further progress test. Others say we're close, but they're pretty much all consistently on the same page that, yeah, we're pretty much at max further progress. And we expect to have that, again, nailed down by the November 4th meeting. That's when that decision will become official to taper. He says we are on track to rotating back down to 2% inflation. However, he does recognize that we might have to taper faster, or again, we are tapering faster compared to last time because supply bottlenecks have been larger and longer lasting than we were expecting. Imagine that. Something was larger and longer lasting than you expected. All right. Then Jerome Powell went on to say that households won't really notice this 2% inflation. He believes the inflation expectations are a little bit high right now, but that they're temporary, they're transitory. He's kind of sticking to the transitory argument, but he does agree that, yeah, look, things have kind of pumped up a little higher and longer than usual. The liftoff. So when you hear the Federal Reserve talk about liftoff, it's important to know they're not talking about a rocket ship. They're actually talking about lifting rates off. And Jerome Powell does not expect to lift rates off until we finish the taper. So no liftoff until the taper is complete. Now, something else that's really interesting is Jerome Powell has previously said, this is a change, okay? Jerome Powell has previously said, hey, we want to keep the essentially interest rates low. We want to keep things accommodative so that everybody can participate in the recovery, specifically Black and Hispanic individuals who are more likely to be in service sector jobs affected by COVID, and women also more likely to be in service sector jobs affected by COVID, and lower rates would help accommodate them better. Jerome Powell has now changed this policy. Well, I wouldn't say he's changed the policy, but he's changed his tune on this. And what he's saying now is, hey, you know what? Congress, via fiscal policies and educational policies, would be much better to help Black, Hispanic individuals and women, and that this might not be a job of the Federal Reserve, that Congress would be a lot more efficient at handling this. He also mentioned that we do not have a lot of direct exposure to the Evergrande crisis. There was somebody for Grande, which I thought we were making fun of yesterday on Millennial Money when we were calling it Everventi. But anyway, somebody actually called it Evergrande, which is fine. I get it. I mean, there's an E at the end, okay? But anyway, so we were making coffee jokes in the chat. But anyway, Jerome Powell says that nobody should assume that the Federal Reserve can protect us from the Evergrande situation. But he says it's not a major focus, and he does not see a lot of direct exposure. I was actually surprised how few questions there were about Evergrande. We've got, let's see here, liftoff. We talked about this. Crypto. Okay, yes, lots of talk about crypto here from the Fed. So Jerome Powell called crypto a currency-like product, which is really good because the last thing people in the crypto community want is their crypto to be considered a security. Because then you get SEC regulation, you get more tax implications. Jerome Powell called it currency-like. Although he wasn't directly referring to crypto, it's possible he was referring to stable coins. So I'm not sure that we could fully bestow like that honor on crypto yet. He does, though, believe that central bank digital currencies and digital currencies in general are very important. He says they're working on a massive report on cryptocurrencies. He says we also have a new settlement system being released for instant payments, instant settlements. That he says there's a quite compelling case for this. He does say that we probably need Congress's support, and we want broad support from Congress and the president to get a central bank digital currency in place. But he does see digital currencies as a, quote, very important innovation. But he does make sure to clarify that it's important to be right and not to be fast, because we are the world's reserve currency. So this is really good. There was a crypto dip. I'm just going to show you the ADA chart here, because I do have a YOLO. I'm sorry, this is the HUD 8 chart. I have a YOLO on HUD 8 right now. I also posted it on Wall Street Bets. But of course, as usual, anytime if you want to see me buy, sell, or trade, it is not for you to copy my trades, but if you want to see it, I post alerts in my Stocks and Psychology of Money group every day. I buy, sell, or trade, which sometimes is infrequent, sometimes is very frequent. It kind of just depends on what the market's doing. But anyway, I did I'll buy a YOLO on this as the minutes were coming out. We did have a period of time here of negativity, and this negativity was because of that accelerated pace of taper. And then, of course, we were all saying, Jerome Powell, just get off the stage and stop freaking talking. We did recover, though, when Jerome Powell sounded a little bit more dovish later and started applauding cryptocurrencies. Okay, so, folks, thank you. Thank you so much for watching this summary. Check out the courses link down below. The price does go up thanks to all that inflation. It's lasting longer and larger than expected. So price will be going up Friday evening. So check out the programs linked down below. Folks, use that coupon code. Now we will see you next time. Okay, now what we're going to do, us here, whoever's remaining, is we're just going to go right into the market closing live stream since it's already 12:34, and why not? I will just separately process the PayPal thing. So we see. All right, let's take a listen.
Politically, that's something the market should be paying attention to. I think it's an important part of how we look at next year and how we need to think about how the dots and the process of responding to whatever happens, inflation or growth differentials that are outside of expectations, how the committee does that, and it makes it tricky. It adds risk premium. It adds a lot of risk premium.
David, so we get that you think he was a bit more hawkish today, and we were discussing the dots with Paul and the likelihood of a hike next year. But you still think that inflation is transitory, so much so I was reading that you're getting hats and T-shirts made. So do you think those points?
There's always a shtick.
We're going to be. I want one, by the way. Free swag always. I think we're just about allowed to accept a T-shirt, I think. But having just criticised the conflicts of interests of Jay Powell owning Munich. but David, so do you think those dot plots are wrong and that we're not going to see a rate hike for many years?
No, I'm not. I don't have a strong look. This is not a lot of rate hikes. But we're talking, even by the end of 2023, it's 4 rate hikes. It's still not even 1 a quarter if we get.
Somebody says I'm a little laggy. I'm going to do a quick refresh. Screen's going to go black for just a second.
How many hawks?
Welcome back to Market Jesus.
Sending a very hawkish message. I do think that what Jay said at Jackson Hole about the long-term disinflationary trends associated with demographics, technology, and debt that are going to reassert themselves, or are very likely to reassert themselves, is the real story in the medium to long run. And the short run story is supply disruptions, which have this alternative effect and create a more of a stagflationary story. That dissipates, that goes away, and then we go back to the problems of the last decade, which are really disinflation problems, not inflation problems. So that's been my core view. It's been my core view for a long time on the long run story. It's how we work this temporary supply disruption story into the equation and how much fuel that gives to what I like to call the inflationistas and how much they're going to push on the Fed and the markets, if you will, and the 10-year Treasury yield as we get, I think, a pretty volatile period for inflation data coming.
And just how temporary it proves to be. And what temporary even is. Yeah.
And Sarah, this is
all right. We're gonna pull off this here. Take a look at this. all of a sudden here, big digital finally coming back to life. Holy moly, big digital's been a little softy. Where's the darn thing? Hello, big digital. Here it is. Look at this. Big digital has just been getting wrecked. And it's finally showing a little bit of love again. My goodness, it has taken a while to get some love onto this stock. Honestly, under $1, it's kind of a bargain. But anyway, so that's big digital. You've got Hut 8 over here. You've got what else do you have? SoFi 11.31%. Playboy 1065. Wow. Okay, what else do we have? All right, let's look at the downside. Let's see what we got here. Okay, towards the downside, we have wow, Lucid really sold off. I closed my sold put on it. Took profit on this one. I've been interested in opening up another one. Show end phase with your channels? Sure. I think it's up a couple percent today, which is kind of cool. Okay, yeah, there we go. So end phase almost up a full 3%. Let's go. That's awesome. What? No options chain available. Wow. See, the problem with big digital is you can't do what's it called on it? Options, apparently. I did not know that. Oh, that's a bummer. I was going to see if there were any options, and there are not. What a bummer. Oh, well. All right. Okay. So what else do we have? Hold on. Give me a second here. Does that work? Man. All right. There we go. I don't know why they make it so complicated. They really do. Whatever. Okay. So where were we? End phase. Yeah, end phase almost up 3%. I don't really know that I have an upper channel. I really just have one channel here. So this is we got 20 minutes to the closing here. End phase is doing very, very well here. Love me the end phase. This is just not working. I'm on TD Ameritrade. Yeah, you guys can see it here. Look at this. I cannot get this thing to work. Can't get anything to work. No, you can't buy big digital on there. I was going to buy. There we go. Did I buy it? There we go. I just bought big digital. You can see it here on screen. Here, I should do it this way. So I've been wanting to buy big digital for a while, but I haven't yet. It's BBKCF on OTC market like TD Ameritrade. Ameritrade. Okay. So anyway, yeah. Let's go back. That's what I was trying to get that in. I don't know why they make it so difficult. Maybe there's just like an internet thing today. I had a couple issues with the internet. I have two internets. I should really just use the better one because one is way better than the other one. Gosh. Yeah, so Webull does not support big digital. This is true. Yeah, you have to use what's it called? Like TD Ameritrade or whatever. Okay, so what else is losing right now? Like let's get some stuff going on here. So Piton's actually recovering a tiny little bit towards the end. Boring. Lucid is at 765 to the downside. The options on this are juicy. They're really let me try. I know you like that. I don't really care if you know. I prefer it. But anyway, the options on Lucid are very juicy right now. And usually when they're juicy, it's because the market is pricing in a fall. So for example, you look at this, you go into Lucid and you go to a sold put. You're sitting at about 10% through October 15th. So if you want to own Lucid right now, it's kind of juicy right now. Just saying, like it's not bad. But I don't know. I haven't executed on it. All right. So then you've got, let's see here. Okay, so ATER is running as well here into the close. HUD 8 mining, 12.4. I got a YOLO on HUD 8. Kind of got one on Big Digital as well. We're finally getting that crypto bounce after this Evergrande disaster's over. We've got Cardano 222. EXP. Wow, EXPI up another 10%. This was just going nuts the other day. I mean, that's tempting for me to look at. Just like I have JP Morgan EXPI. I don't think I have any calls on it. I think I already closed my calls on it the last time we were at 50. Yeah, no, I don't have any in Webull. I closed my calls on it, but I have a ton of shares of it. Let me just make sure I don't have any calls left on it. We got 17. Because I don't like holding calls too long. I don't mind holding shares though. I don't really care. Yeah, here I got 1,600 shares here. And then I have a bunch of shares in JP Morgan too. Options. No options. Okay. Enphase. I like seeing Enphase go up. I have one call contract left on Enphase. It's tiny little bit positive. It's a few $1,000s. But of course I own tons of shares on it. I'd love though to see that to see Enphase run back to like 200. Although I don't know if I feel that way because I kind of want to keep buying the darn thing. That's the struggle when you love a stock. And it's running nicely here into the close. I bought a multiple six figures yesterday because I bought it like 2 or 3 times yesterday. But anyway, Enphase is great. Some people bag on it, but they don't understand. Toast. I'm surprised Toast is at 62. A little bit high, little low. You've got. Oops. There we go. Wait. Is BB not on the watch list? Oh, this isn't even on the watch list, is it? Add to what? No, it is. Oh, that's odd. Stocks recently viewed. Oh, I'll just keep it here. All right, anyway. Looking at the downside. Lucid, Dutch Bros, Piton. Piton wasn't juicy enough yet to sell puts on. I was really thinking about it, but not juicy enough. Canoe is one that like some of these. I just think we're in this market now where the SPACs are starting to come back, the ones that aren't likely to go bankrupt. And the reason I think the SPACs are likely to come back is because hold on one sec. Okay. Okay. All right, that's done. Anyway, yeah, there's so much money right now in these, and personally, I wouldn't be surprised if some of just the leftover sold off companies come back. We'll see. Because I mean, Monday to me was a perfect example of like there's no dead cat bounce because there's no dead cat. And the reason for that is because you really have so much cash on the sidelines that people are literally buying everything right now, especially things that have dipped. There's so much money. That's nuts. That's all I can say. It's just nuts. Anyway. All right. What else do we want to do? I don't know. We got 13 minutes to the close. Should we do short interest? Why don't we do that? We could do short interest and we could see why or like maybe which SPACs have some juice in them, huh? I like that idea. I'm game for that. All right. I will pull up short interest here. Hold on. Give me a sec. I gotta press that button. All right. Do you want to continue your session? Yeah, buddy, I do. Don't take my session away from me. Apps portal. Gotta go to the portal. All right. There we go. Okay, it's coming up. Just one sec. Y'all already putting in tickers. Funny. Give it a sec. All right, here we go. Okay, I got it up. All right, let's go. Oh, keep in mind, of course, you can get yourself one free stock worth all the way up to $70 with Public by going to metcalvin.com/public. And you can check out the programs linked down below for Building Your Wealth. Coupon ends on Friday and the price goes up, blah, 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 blah. Okay. All right, I did my job. Now that my job is over, let's have some fun. Peloton, 11% short. Wow. FUV, 33% short. Wow. BBKCF. I don't know. Does that actually show up as short? No. Big Digital doesn't. Smile to STC is 35.11%. Root is 28.25. LCID. Oh, Lucid's getting shorted. Look at our chart. Oh my, Lucid is getting shorted. Look at that. It jumped from 8.5, low of about 7.75, just to 10.7. I told you those shorts are looking juicy. So the market's pricing it in. This is what's happening here. And so that coffee's good. This is Slayer coffee. Have you ever seen Slayer coffee? Look at that. All right, where were we? OGEN. Ocugen. No, that's not Ocugen, is it? No, it's not. Ocugen is OCGN, isn't it? I'm pretty sure that's OCGN. OCGN. That's Ocugen. There he is, 25.11. Look over my head. That's where you see the numbers. If you missed it, look at the little thing right here. Enphase. Enphase is pretty low. People love Enphase. 3.8. Yeah, I mean, that's like a Tesla. Affirm. 5.6. Oh, Affirm's come down a lot. EV Go. 15.2. Ooh, EV Go's going up. Ooh. What about EV Go and ChargePoint for the YOLOs? Ooh. I'm going to write that down. EV Go, ChargePoint. ASTR. Nano Dimension. 8.63 on that one. Nano Dimension is 8.4%. It's actually come down recently. Palantir, 3.25. Hippo. That's the hungry hippo. Hippo's got like no short interest. Pretty low. Hippo's just like a fundies. It is insurance though, so you're waiting for them to make money, but I like that one. I think they really got depressed on their last earnings for a silly reason, but I've done full videos on that one, so you can watch that in detail. DD 2.54% short. It's actually going up. Makes me wonder what Baba's doing. Baba 1.89. Lemonade. If Lemonade runs, Hippo will probably run too. 29.4. PLBY. 9.3. It's been going down. Redfin. That's a good question. 12.11. I wonder how Kathy's doing. ARK. And that's 11.61. DKNG is 9.61. Skills. All right, I'm not going to do any more of these. 28.6. I'm bored. Moving on. All right. What do we got? What's going on in the world? Oh, look at Robinhood up almost 10%. Let's go. You know what's so crazy? You might not, I mean, like, I think you should believe it because I said it live and I said it in the course member chat like multiple times when I sent the alerts. I said, actually, you know what? Hold on a sec. Hold on. This is too good. So I sold Robinhood calls when the thing ran up crazy to like $70 or something like that. And then, when was it? Hood. So it's so crazy. Where the heck is it? Gosh, there's so many trades. Kevin, stop making money. Where's FUV, Palantir, Smart, HIPAA? I have no idea where it is. Oh, there we go. Sold. Oh, got it. Here it is. Come on. It's right above that. Here it is. Okay. Look at this. So I'm putting that on screen. Change cameras. Okay, so check this out, folks. I put this up on September 14th. I go, closing my Robinhood sold call. FYI, I bought Robinhood at $34.20. See history above on IPO day. Anyway, it ran to $70. I sold a call option against the position. They expire Friday, so they would have expired anyway, I guess. But anyway, but the option had already become worthless for the buyer, so I can buy back the option now for basically realizing 99%. Listen to this. This is what I was concerned about, and that's all I wanted to bring up, my concern. It literally says it there, unedited from September 14th. Read that last, the second to last sentence there. I could hold until Friday, but let's say Robinhood releases crypto wallets and it runs, I'd give back some of that gain. They literally released crypto wallets. Now, they released them a few days later. They started talking about this yesterday, right? So I was 2 business days too early on that, but I just had a feeling. I'm like, it's going to be coming soon and that sucker's going to run. So that's too funny because look at Robinhood now up 10% right here. That's crazy. Robinhood up 9.93% right here. Let's switch back to that. EXPI is running very, very nicely. SoFi's doing great. You've got Hut 8 mining, and how's BTC doing? Did Bitcoin pull back a tiny little bit again? BTC 43.41. So it's kind of been vacillating after the Fed meeting here. And let's see here. Oh, Workhorse is down a full 10%. Lucid down 6.8. Okay. G-Tech, Fannie. Big Digital, SoFi. Just looking for other things here. I mean, these are great runs here. Yeah, Robinhood $46 now. What my sold puts are on that? I'm gonna take a peek. Sold Robinhood. Hood sold puts up 49% on the last sold puts I did. Oh, that's cool. I only took a 20K credit and they've already realized 10. Well, it's because it's running. Let's keep going. All right. What else? So 3 minutes to the close. Lucid 6.94. I really so badly want to sell puts on this. I gotta run a poll really quick, okay? Because I want to see what the market knows about this. So without saying anything, I'm gonna run a poll. When will Lucid start delivering its first car? Okay. Within 1 month, within 2 to 4 months. One of these answers is what I was told by Lucid. Okay. Okay. So I just posted it, and it should pop up in the chat. I want to hear from you, like ASAP, within like the next 2 minutes here, because I want to know what the people know. If this is like super well known, or the expectations more or less. I don't know. So anyway, that poll should be up here at some point. Anyway, okay. So while we wait for that, I sent it in. I still don't see it though. Where's the stupid poll? I still don't see it. Whatever. Whenever you see the poll, there it is. Okay. Oh, so y'all are already voting. Oh, sweet. Yeah, vote quickly, please. We only got 2 minutes. Wow. Wow. Really? I mean, they could be wrong. That's interesting. Poll should have a don't know option. Well, if you don't know, don't vote. All right. Let me see. I'm gonna look here. So I'll go to October. I'll go to my handy dandy over here. I don't know. Should I go 24? 193 for 50 cents. Oh yeah, no, 25 for sure. I'll go 100 times 25. That's too much. I'll probably go 50 for October. That's fine with me. No, you know what? Screw it. Go 100. Oh, insufficient buying power. Crap, I made too many purchases. I hope that goes 3. All right. I don't know if that's going to go through before the close, but whatever. Okay. That's okay. So why did I do that? Why did I sell put? Because Lucid has said they're planning on selling their car. Well, let me give you this, okay? Oh, the bell. Hold on.
For the S&P 500. Who gets fireworks? I would not be disappointed if I rang the bell and didn't get them.
Fireworks inside. That was AKA, the company that went public, the retailer today, ringing the closing bell. Stock actually finished lower, though they did have a nice celebration here. Welcome everyone to the closing bell. And now they're chanting. I'm Sarah Isaac with Wilford Frost. And
wow.
CNBC
That's a lot of excitement there. Yeah, Dow up 1%, S&P up 0.95%, NASDAQ up 1.02%, Russell 2000 up 1.48%. Okay. Wow, they are hyped over there today. That is exciting. Okay, so Lucid. Let's look at the poll. 43% of you said the car would start delivering within 6 months, or 6 months plus. 6 months plus was 44% of you. 4 to 6 months was 21% of you, which means collectively 65% of you think it's going to take more than 4 months to deliver the car. 12% of you said within 1 month, which was and 23% said between 2 and 4 months. According to Lucid, the first deliveries should be coming out within 2 to 4 months. That's what they texted me. That's and that's not like I'm like an insider or whatever. I don't own any shares. They just pre-ordered the car, so it can't be secret info. I mean, imagine they're saying that to anybody who's pre-ordering a car. But anyway, thought I'd mention it. So I think that's an interesting moment. So if I can do, hey, look, 23 day put, a sold put for, and I get a $12,000 credit or whatever. I could always close it early too if I want, or just hold it if it goes down, whatever. That's okay with me because I don't mind getting assigned to those shares. See? Thank you for reiterating that. It's not just me who heard that. I cheated. I heard it from a friend with a pre-order. There you go. That's what I'm saying. If 2 to 4 months is true, they would be a strong buy. That's what I'm saying. I know. That's why I just sold some puts on it. No guarantees. All right. So, anywho, of the day. How's the bigger question is, how's crypto doing? I don't know. That's really the bigger question. It's just, it's mostly sideways. I mean, it dipped a little bit there and came back. Here we go. There you go. What is it, trying to head and shoulders us? Anyway. All right. So let's see here. All right. To the downside, we have Workhorse, Camber, FedEx, Dutch Bros, Lucid, Peloton, G-Tech, Facebook. And Smile Direct down again, 3.25%. Going back to the gainers. Big digital assets at 105. Oh, it's over $1 again. You've got ATR up 28%. Hut 8 Mining 11.92%. Also, ATR running a little bit in the after hours here. It's up about 5% now. Hut 8 Mining a little bit up in the afters, 0.35%. SoFi did really well today, up 11%. I realize I do have, by the way, shares. Is it fuzzy again? Well, hold on a second then. Here, it's going to go black for a second. I don't like that fuzz. Hopefully that's better. But anyway, let me see if I can pull up Public. You can follow me on Public at Meet Kevin there. But let me see. Where's my Public? Okay, I get it. Referrals, whatever. Oh, I didn't know I had a firm in here too. Oh, that's cool. Look at this. Let's see here. This is my Public. I have 78K there in SoFi, $8 in Amazon, and a firm is 7,400. But anyway, yeah, you can follow me on here. It's at Meet Kevin. I gotta bring some more money in here. I'm a watch list. It's kind of cool. 10.5% today. I guess that's not bad for Public. Which firm? A firm. We played RuneScape on Dialed Up. I used to play RuneScape. That's so funny. I was just thinking about that this morning, how I played RuneScape on Dial Up during hurricanes. Until, of course, the power went out because we didn't have laptops back then that had strong enough batteries. All right. Very firm, affirm. How firm? All right. So EXPI killed it today. I really think Wall Street just undervalues that one. But that's why we bought it before their split. It was $40 before the split. Now it's $40 after the 2-for-1 split. It's $48. It's great. This is like $90-something pre-split. It's been through a ride, though. Don't get me wrong. Like things that goes on a roller coaster all the time. Robinhood. I wonder if Robinhood's going to go on a euphoric run again. Good thing I don't have any sold calls on it. So that's why I like sold puts. Like, see, with a sold put, okay, what worst case scenario? You buy the stock, right? With a sold call, you could run and potentially, lose out and miss out. It's like a worse feeling, in my opinion. I mean, it's basically the same kind of contract, just in reverse, but still. Lucid. Okay, so QuantumScape, DoorDash. Okay. All right, cool. Well, folks, I don't know. Is there anything else to talk about? Let's look really quickly at what they're saying on the Googs or on the boobs, the Bloombergs. My mom hangs up the phone and RuneScape freezes. That's right. Gotta keep people off the phone. Can't be PKing on dial-up. And if you do go PK, bring your lobster. I got my cooked lobster here. This is my buddy. There we go. How's that? We should do a thumbnail pose with it. I got out that cooked lobster. Got my dagger. Lobster and the DDS. Always. All right. What do I got to do now? Okie dokie. Good. What's next? We're in hot water lobster. Plain rinse right now. That's funny. Deer with a lobster. All right. Powell says taper could start in November, finish mid-2022. That's correct. Talked about that. Powell says Fed trading policy not adequate for public trust. Okay. Cautious stance on stocks makes sense, says Deutsche Bank. Blah, blah, blah. Okay. I don't know that we really have that many exciting updates right now beyond everything that we already covered. So I think we did good here. Bitcoin softening again a little bit. Bitcoin's just being a little weenie baby right now. That's what it is. Just go make another coffee and leave. Who cares? Whatever. All right, folks. Thank you so much for being here. We'll see you tomorrow after crypto skyrockets. Anyway, appreciate y'all. I'm sure I'll make another video. I probably will. I'm probably going to post the Jerome Powell video like in 4 minutes. All right, folks. We'll see you next time. Bye.